So before I get started, just like to say I am not a financial advisor. This is not financial advice. I'm not a suit. I trade stocks from my spare bedroom, so you can take it or leave it. But my talk is basically how to make 1 million in 4 steps. It's quite easy to do, which I will show you. It is not going to happen overnight, so if anyone's here thinking next week they're going to be worth 1 million, my talk will be a waste of time, so please feel free to leave. But first of all, you need to open a stocks and shares ISA, and these are tax-free wrappers which exist in the UK, which is great because in other countries you have to pay capital gains tax, and when you put your money into an ISA, it is free from the clutches of HMRC. So you can make any amount of money in a stocks and shares ISA, and it is completely tax-free. It is amazing. Any stocks and shares ISA will do. What I would suggest to do is to look at the charges of every individual ISA, because some of them will charge a custody fee, some of them will charge ongoing fees, and over time, this can really make a difference in the amount that you hold in your account. Now, I would recommend to have a look at Vanguard. I'm not paid by Vanguard. I just think they have very cheap products. And when you go on the website, you will get offered 2 options. One of them will be a do-it-yourself account, which charges 15 bips, and then the fund charge. Now, if you have a large amount in that, obviously that percentage is going to be quite a decent chunk of money, whereas if you go with a different provider and pay a fixed fee, it might be best for you. So there's no one-size-fits-all with ISAs. You do need to do your own research and check which one is best for you. Some important information about ISAs. So as I said earlier, you can only transfer 20,000 into an ISA. You can only open 1 stocks and shares ISA account per year. So if you do accidentally open 2 in the same year, it's probably best to contact HMRC and let them know, because what you don't want to do is 20 years in the future, they come and have a look at your things and say, right, well, you opened this ISA wrongly, therefore we're going to tax it all. So everything that you do, just make sure you do it properly and with care. The current tax year is the 6th of April 2023 to the 5th of April 2024, so you do only have a few weeks to use your ISA allowance, and it is use it or lose it. So on the 6th of April this year, if you haven't used it, it's gone. Now, there is one trick that you can do with IG in order to roll it over, and any provider that is a flexi ISA, what you can do is you can transfer whatever you want to roll over into the next year on the last day of the tax year, and then when the new tax year starts, you simply withdraw it, and then you've rolled over that amount, plus you've got your extra £20,000 allowance. Step 2, buy this fund. This is the S&P 500 fund. You can invest in World or any other fund, but this fund has been a great performer over time, and you will own shares in all of these companies. The idea is that you put your capital into this fund, and then all of these employees basically work hard for you over the years. So employees are Coca-Cola, Amazon, American Express, Tesla. Essentially, they'll be working for you as part owners of these businesses. Make sure you click accumulating. This is a top tip. What you want to do is reinvest all of the dividends back into the fund to acquire more units and allow that wealth to build over time. Step 3, you've maxed out your ISA allowance. You've maxed out any partners' ISA allowance. The next step is to open a SIP, which is a self-invested pension plan. And what this does is it reduces the taxes that you pay. It does come at the end, so it is taxed. It's not completely tax-free, but it essentially kicks that tax can down the road to a later date. And if you earn up to £50,270, every 80 pence that you contribute, you will get topped up to £1. And if you earn above that into the higher rate, you'll get 40% tax relief. So this really is quite impressive. If you have a limited company, not only will you get the tax rebate because you are not paying corporation tax, but you'll also get a top-up from the government as well. So what we do with the extra money in the SIPP is we buy more shares of that fund and buy more units. And then we move on to step 4, which is keep doing the first 3 steps, and that is it. And it's quite easy. The S&P 500 has averaged 9.77% from 1900 to 2022. That is a pretty good bet. Obviously, if there is a nuclear war tomorrow and we're all dead, the stock market probably will go down, and that will be the least of your worries. Some top tips here. Do not deviate from the strategy. It is tempting when someone brings up some new crypto coin that is gone up 10,000% and you think it will go up another 10,000%. It probably won't. Usually what happens is these are scams where they pay people to pump the crypto and get out. It's the same as any stock. The pump and dump operations and crypto is like the Wild West at the moment. If you do want to do that, put a small allocation of your total wealth into crypto, but nothing that you can afford to lose. Do not stop the payments at any reason. Now, during COVID, a lot of people said, oh, the market's gone down, I'm feeling a bit scared. But actually, 4 years later, even though the market is down, there's a lot of wealth that's been built over that time. The S&P is trading towards highs, NASDAQ is up. In the long run, you will most likely win. Do pay yourself first when you get a pay rise. So a lot of people, when they get a pay rise, they'll buy a bigger car, a bigger house, new fridge freezer, lots of new gadgets, and at the end of the month, they're just as broke as they were before the pay rise. What you should do is pay yourself first. So increase the direct debit into the ISA and buy wealth accumulating assets. Be willing to play the long game and invest only what you don't need at the moment. The worst thing that you can do is in 3 to 4 years, you need the money and the stock market is down. Not only are you pulling it out when you should be buying more, but you're pulling it out at a loss. But wait a minute, because this all sounds so easy so far. Now, if it's that easy, why doesn't everyone do it? The simple answer is nobody wants to get rich slowly. Everyone wants to get rich, myself included. I imagine everyone here wants to become wealthier. Wealth building just doesn't happen overnight. I've tried it, it didn't work. I lost a lot of money, so trust me on that one. Is this guaranteed to work? Nothing is guaranteed to work. As I mentioned earlier, the S&P 500 has averaged 9.71%, so I was out by 6 basis points between 1900 and 2022. Betting on the US has historically been a good bet. And if you are 80 years old, will this still work? The answer is sorry, probably not. You do need to be invested for the long run, and by the time the compounding effect kicks in, you'll probably be dead. I do apologize, but certainly if you're in your 20s, 30s, 40s, you've got hopefully a very long time to get that investment compounding kicking in. Thank you very much for watching. Just a quick recap here. Open a Stocks and Shares ISA, set up a direct debit to buy the S&P 500, reinvest the dividends. If you've maxed out your ISA and your partner's ISA, open a SIPP and continue to buy the fund and pay yourself first. Follow steps 1 to 3, and that is pretty much it. If anyone wants to email me, my email is michael@shiftingshares.com, along with my website, shiftingshares.com. Thank you very much for joining. Hopefully that was helpful, and enjoy the rest of your day.